Welcome to Talk Tickers. We are diving straight into Pathward Financial, that's ticker CSH, right after their Q4 fiscal year 2025 earnings call.
Yeah, this one dropped after the close yesterday, October 21st, and definitely stirred things up a bit.
Stirred things up is right. It created some immediate volatility. You know, it's one of those classic kind of complicated stories for the market.
How so?
Well, you had this massive, undeniable earnings beat, really strong bottom line.
Okay.
But it was paired with just enough, let's say, top-line softness and definitely some credit anxiety to push the stock lower in after-hours trading.
Right, the classic push-pull. So our job today is really to unpack what management said, especially how they defended their fiscal year 2026 guidance against that pressure.
Exactly. We need to figure out what the market should really be focusing on. Is it that spectacular Q4 profit, or is it more about this maybe temporary fear that caused the selling?
Management clearly wanted to focus on the future. They laid out a blueprint that, well, if they pull it off, it fundamentally changes how you'd value this company compared to, say, a traditional bank.
Okay, let's start with the big picture results now. The punchline for the full year.
Full fiscal year 25 EPS landed at $7.87. That represents about 9% growth year over year. Solid.
Solid, yeah. But the quarter, Q4, that's where the real fireworks were on the bottom line.
Absolutely exceptional, really.
Yeah.
GAAP EPS came in at $1.69.
Okay.
And remember, the street, the consensus, was looking for $1.39.
Wow, so that's what, a 22% surprise beat?
Exactly, a 22% beat. I mean, in this kind of environment, delivering that sort of outperformance, it's pretty rare.
It really is. But here's the nuance, like you said, the push-pull.
Yeah.
And this probably explains why the stock got hit initially.
The revenue number.
Yeah. Revenue for the quarter was $186.7 million. Just a bit shy in the consensus target. Missed by about, what, 1.5%?
Not a huge miss, but enough, apparently.
Enough for investors to maybe penalize the slight softness there and then, immediately jump on the credit concerns we'll definitely get into later.
So they're celebrating the bottom line profit, but worrying about the top line momentum and maybe what's under the hood on credit.
Perfectly put. So what's fascinating then is how they managed that huge profit beat despite the slight revenue miss. It wasn't just luck, right?
Oh, not at all. It was really about margin execution and strong fee income. Let's talk net interest margin, NIM,
okay.
Powerhouse number, 7.46% for the quarter.
7.46, wow.
And that was up 14 basis points year over year, significant jump.
And the other piece, fees.
Non-interest income, yep. Also very strong. Increased 13% year over year, hitting $58.8 million.
Okay, so that tells you the profit wasn't just, riding a lucky interest rate wave. It feels more structural.
That's the narrative management pushed. It was about execution, particularly around the balance sheet.
All right, let's unpack that structure then. Management kept talking about balance sheet optimization, repositioning the portfolio.
Yeah.
What specific things did they do that let them keep that NIM so high?
Well, the key driver was some pretty surgical divestiture activity earlier in the year.
Okay.
They successfully got out of the insurance premium finance business, and they also sold off a transportation loan portfolio.
Right. I remember those announcements. Were those particularly risky or just?
Not necessarily high risk, but think lower yielding.
Yeah.
And maybe more capital intensive than where they want to be.
Okay.
So shedding those allowed them to redeploy capital more effectively. It instantly raised the average return profile of what was left on the books.
And that helped lift the NIM even while funding costs were generally going up everywhere.
Exactly. It shows good spread discipline through active portfolio management.
Makes sense. They turned the capital heavy, maybe lower margin lines.
Mm-hmm.
Did they signal if this was like a one-time cleanup or is this an ongoing thing? Because, that 7.46% IM, how sustainable is it if it's boosted by sales?
Good question. They framed it more as the successful completion of a specific repositioning phase. The goal wasn't just NIM, it was about lifting their core profitability metric.
Which is?
Return on average tangible common equity, ROATCE. They're targeting durable mid-teens OATC.
Mid-teens, okay, that's ambitious.
It is. And achieving that signals, highly efficient capital use and makes them look less like a generic regional bank, which is super sensitive to rates, and more like a specialty finance or platform company.
That distinction feels really key to their whole story. Okay, so they're optimizing assets, but they're also giving capital back to shareholders too, right? Buybacks.
Exactly. They weren't just shrinking or optimizing. They were also growing the core and returning capital. Total gross loans and leases actually grew to $4.66 billion. That's up almost $600 million year over year.
Okay, so growth and buybacks.
Yep. At the same time, They were pretty aggressive on the buybacks in Q4, bought back about 180,740 shares.
Know the price.
Average price was $82.95 per share.
So doing both growing the asset base and buying back stock, that usually signals pretty strong confidence from management about future earnings.
It does. It suggests they believe the underlying earnings power can support both growth and returns.
Okay, before we shift fully to the platform strategy, let's quickly touch on secondary market revenues. Sometimes those can be, lumpy or mask underlying trends. Did management give any guidance there?
They did address that. They basically said they view secondary market revenues at a more normalized run rate of about $5 million to $7 million per quarter.
Okay, 5 to 7 million.
Right. They acknowledged Q4 was higher than that. They attributed it to some opportunistic sales, basically, hitting good bids near the end of the fiscal year, particularly on some renewable USDA paper.
So they're kind of guiding down from the Q4 actuals for that line item.
Effectively, yes. But framing it as moving towards a more predictable, stable run rate, it suggests they want investors to focus on the core recurring revenues, not potential one-off gains from sales. It's about maturity.
Got it. Okay, now let's really dig into the future, this strategic shift they keep highlighting, the capital-light, partner-delivered finance model. This seems to be the absolute heart of the bull case for cash.
It absolutely is.
What does this model actually mean in practice, beyond just signing up new partners? How does it change Pathward?
Well, think of it like this. They're moving from being primarily a direct lender to being the essential infrastructure for a lot of fast-growing fintech companies.
Infrastructure like?
Like the regulatory plumbing, the technology connections, and sometimes the short-term balance sheet capacity. They become the bank sponsor, the regulated entity that allows these partners to launch payment and lending products quickly.
So Pathward provides the license and the rails, the partner brings the customers and the product idea.
Pretty much. It's a classic platform model. Pathward earns fees for enabling the transaction flow.
And they announced a whole bunch of new deals that kind of illustrate this, right? Who are the key ones we should be watching?
Yeah, there was a flurry of announcements, shows they're diversifying that fee base. They signed Trustly, that's for supporting pay-by-bank settlement. Huge potential volume there, starting with a major national retailer, apparently.
Okay. Trustly, who else?
This one's big. They locked in a multi-year deal for merchant acquiring sponsorship with Stripe.
Stripe, wow, okay. That's a significant name.
Huge seal of approval for Pathward's capabilities. And then, just after the quarter ended, they signed with Greenlight.
Greenlight, the family finance and teen debit card company.
That's the one. Again, another high-volume, likely fee-heavy opportunity that probably requires very little of Pathward's own capital on the balance sheet long-term.
Okay, that makes sense. Let's talk about one specific partnership that might raise some eyebrows, though. Upstart. Given Upstart's own volatility and focus on lending, investors might worry about Pathward taking on credit risk there.
Understandable concern, and management addressed it directly. For investors who hear Upstart and immediately think credit risk blow-up, Pathward has built in some significant protections.
How so? What's the structure?
Critically, these loans originated through the Upstart partnership are designated as held for sale.
Held for sale, meaning?
Meaning they only plan to keep them on Pathward's balance sheet for a very short time. Think 30 days or less.
Okay, short duration helps. But what if the loan goes bad in that short window?
That's the other key piece. These loans carry credit indemnification protections.
Indemnification. So let me simplify this. If a borrower defaults quickly, Pathward isn't actually the one taking the loss. The partner, Upstart in this case, essentially covers it.
Precisely. That's the beauty of this capital light model when structured correctly. Pathward uses its charter and systems to facilitate the loan origination, collects fees for doing so, and then shifts the long-term credit risk back to the partner protected by those indemnity agreements.
Okay, that's a crucial detail for understanding the risk profile.
Yeah.
They also mentioned expanding in early wage access, right?
Yeah.
Through the Claire partnership.
Yes, another interesting platform play. Claire, which provides on-demand pay or early wage access, announced they're now available through the Intuit platform.
Intuit, meaning QuickBooks Payroll.
Exactly, leveraging that massive QuickBooks small business ecosystem. This positions Pathward as Claire's bank partner for potentially huge volume growth in that space. Again, using existing enterprise infrastructure, not building direct-to-consumer channels.
Pure platform leverage, like you said.
Yeah.
Okay, so lots of positive strategic momentum on the platform side. But here's where the market, threw the penalty flag after the call.
The NPLs.
The non-performing loans. Despite all this good news, the stock dipped. And the NPL spike seems to be the main reason. This is the real friction point between the management story and how investors reacted. What exactly happened with NPLs?
Management was pretty candid, but also very firm on this point. They stated the rise was driven overwhelmingly by a concentration in just 3 specific commercial finance loans.
3 loans, only 3.
That's what they emphasize. 3 specific loans. They were explicit that this is not a sign of broad systemic deterioration across their, diverse loan book.
3 loans driving a noticeable spike.
Yeah.
That almost sounds less like random episodic noise and maybe more like concentration risk, or maybe a slip up in underwriting on those particular deals.
That's definitely the critical question the bears are asking.
Management claims they're well collateralized.
Yeah.
But if the collateral is so good, why did they become non-performing and stay that way for the quarter?
Yeah, that's the pushback. Management's defense really hinges on the quality of that collateral, especially for one large working capital loan that seems to be the main driver of the increase.
Okay.
They maintained confidence that NPL movements like this can be episodic and, importantly, stressed that it doesn't correlate well with their annual net charge-off rate.
And what was the charge-off rate for the year?
It was 64 basis points for fiscal 25, which, as they pointed out, is well within their historical range and risk appetite.
Okay, so they're saying, don't freak out about the quarterly NPL number. Look at the annual charge-offs, which are behaving normally. But investors still need to know when this NPL issue gets resolved. Did they give a timeline?
They did. They said they expect these specific NPLs to resolve over the next 1 to 3 quarters.
1 to 3 quarters, so within the next 9 months or so.
Right. Either through the borrowers getting back on track, becoming performing again, or if that fails, through liquidating the collateral.
Well, the market's basically betting it takes longer, or the collateral isn't quite as good as management thinks. While management is betting, they can clean it up relatively quickly.
That seems to be the crux of the disagreement right now.
Okay, so despite this NPL headache, management stood absolutely firm on their longer-term growth story. They reiterated the fiscal year 2026 guidance.
Rock solid on it. Sticking to the FY2026 EPS target range of $8.25 to $8.75 per share.
$8.25 to $8.75. That's still a pretty big number compared to the $7.87 they just did for FY25. What assumptions are baked into that confidence?
Well, notably, the assumptions are quite conservative on the macro front. First, they're assuming no rate cuts from the Federal Reserve during fiscal 26.
0 rate cuts baked in. Okay.
Second, an effective tax rate between 18% and 22%. And third, importantly, they expect to continue buying back shares, which helps boost the EPS number by reducing the share count.
So they're planning to hit that $8.25 to $8.75 range based on their own execution and buybacks, not relying on help from the Fed cutting rates.
Correct. They seem to be modeling for execution risk, but not assuming any macroeconomic tailwinds.
They laid out a kind of 5-point strategic blueprint for hitting that 2026 target. Can you quickly remind us what those were?
Sure. It was 1, maintain that optimized balance sheet mix we talked about. 2, keep investing in technology for growth and scalability. 3, focus on people and culture, including sticking with their remote talent anywhere model. 4, continue maturing their risk and compliance framework, probably even more important now given NPL focus. And 5, improve the client experience and, crucially, speed up the pulling through of that opportunity pipeline.
Okay, that 6th one sounds key. Improving client experience and pulling through the pipeline. Does that basically mean getting those new partners like Stripe and Greenlight onboarded and generating revenue faster?
That's exactly what it implies, reducing the time to yes and the time to revenue for new partners.
Which of those 5 points carries the most execution risk, do you think? Where could they stumble on the way to $8.75?
For me, it's definitely that 5th one, improving the client onboarding speed and pulling through those opportunities.
Why that one specifically?
Because the whole platform thesis, that mid-teens ROTCE story, it only really works if they can sign and efficiently onboard and scale these high-volume fee-generating partners quickly.
Right. If the regulatory complexity or just internal processes slow down that onboarding.
Then the projected revenue from those big new partners gets pushed out, and hitting that $8.25 to $8.75 range gets a lot harder. The speed of execution on the platform side is everything.
That makes perfect sense. So the core message is, Pathward is trying hard to convince the market they're not just another regional bank swaying with credit cycles and Fed policy. They want to be valued as a durable, high-return platform.
Precisely. The entire investment case hinges on whether they can actually decouple their valuation from something like the KRE, the main regional bank ETF. Prove they're different.
And that leads us perfectly into our This is Not Financial Advices segment. Because you have this clear mismatch, right? Huge EPS beat, strong guidance reiterated, but the stock dips because of what management calls temporary concentrated credit fear. Seems like a potential mispricing.
I think that's a reasonable take. The market reacted to the NPL news as if CCH were just a standard regional bank facing broad credit issues.
But the argument is it's not broad. It's isolated to these three situations, which they expect to resolve relatively soon.
Right. And meanwhile, the underlying platform engine, the fee income, the capital protection via indemnities, that should allow CCH to potentially outperform those generic regional banks significantly over the next, say, 2 quarters as the NPL story fades and platform revenue grows.
Okay, so if we're betting on that decoupling, what's the trade idea?
Thinking short-term volatility trade here. Go long cash, but simultaneously short the KRE, the regional bank ETF.
Long cash, short KRE. Explain the rationale there.
The long cash position is a direct bet on 2 things. 1, management successfully resolves those 3 NPL situations within their guided time frame, removing that overhang. And 2, they execute on that high-margin platform strategy, proving the earnings power is real.
Okay, that's the bullish bet on the company itself. Why short the KRE alongside it? What does that achieve?
The short KRE acts as a hedge against broader market or sector weakness. If general concerns about interest rates or the economy or some other macro fear hits the entire regional banking sector.
Which could drag CCH down even if its own story is okay.
Exactly. The short KRE position would profit from that sector-wide dip, hopefully offsetting some or all of the loss on the long cash H position caused by general market malaise. We're isolating the bet primarily to Cashish's specific situation relative to its peers.
But hang on, isn't there a risk there? What if those 3 NPLs don't resolve quickly? What if it turns out to be a bigger issue? Wouldn't CH potentially drop more than the KRE in that scenario because you have this specific known problem? The hedge wouldn't work then, right?
That's absolutely the risk you're taking. It's a calculated risk. The hedge protects primarily against systemic or sector-wide fear hitting all regional banks. It offers less protection against idiosyncratic risk. That is, risk specific only to cash age, like those NPLs proving worse than expected.
So if the NPLs linger past, say, 3 quarters, this trade could be in trouble.
It could be, yes. But the bet is that the premium you effectively pay by having the hedge buys you time. Time for the NPLs to hopefully resolve is guided, and time for the positive platform story, the revenue flows from Stripe, Greenlight, Trustly, Upstart, to become more visible in the numbers.
So you're hoping the market starts to recognize that platform value and re-rates the stock towards that $8.50 midpoint of the 2026 EPS guidance, even if there's some sector noise.
Essentially, yes. It's a bet on Pathward's specific execution, winning out over both temporary credit panic and potentially broader sector headwinds.
Okay, a compelling setup. Really highlights the tension in this quarter's results and the story going forward. So let's recap quickly. Pathward's Q4 delivered a surprisingly strong EPS beat, really fueled by smart balance sheet moves and that high margin fee income from partners.
But that strong performance was immediately sort of overshadowed or at least complicated by that spike in non-performing loans, even though management insists it's concentrated in just 3 specific situations.
Right. So the central question for you, the listener, really boils down to this. Do you believe management can actually execute this transformation into a capital-light, high-ROE TCE platform company?
Can they prove that this NPL spike truly is just an episodic, temporary story like they claim? If they can, they might successfully decouple from the broader regional banking sector.
Or conversely, does that slight revenue miss maybe signal that scaling these crucial new partner relationships is going to be slower, maybe more complex than the market hopes, making that 2026 guidance harder to reach?
That roadmap balancing the speed of onboarding new partners with maintaining robust compliance and risk management, that feels like the absolute key thing to watch in the coming quarters.
Absolutely. Well, thank you for tuning into this deep dive on Pathward Financial. Just a reminder, we're summarizing information from the company's call and related analysis. Nothing discussed here constitutes financial advice.
Please consult with a registered financial professional for advice tailored to your situation. We'll catch you on the next one.